on the tube, on the YouTube. Come on in, everyone. Come on in, enjoy the fun. It's a very happy day today, Lee.
Why is that?
You don't know why today's very happy?
I think we opened 3 escrows so far.
There's that, but the killer of LA is dead. The murderer is
Be careful the words. Careful the words.
No
We'll get banned.
mas.
We'll get burned. We'll get banned.
He's no longer on this earth. Mr. Orange Juice, James Orenthal himself.
Yeah.
Gone.
It's all weird, man.
I don't have to worry anymore.
It's all weird.
I thought I was next.
It's all weird.
I thought I was next.
It's all weird, dude. It's all there is to it.
You know, his wife, and then me, and then God knows who else. But we're good, guys, because O.J. Simpson is no longer with us. I don't know how you guys feel about that, but I heard he was a great running back in his time. Before my time, but I heard he was great. Anyway, we're here to answer all your home loan questions, real estate questions, programs, interest rates, credit, what it takes to buy a house, all the things necessary for home loans.
What's up, Stephanie?
So let us know in the chat box. Fill up this chat box, guys.
Iso, Mohammed, great to see you. Apple user, what credit score you need? Right away, out of the gate, coming in hot.
I need 850.
Coming in hot.
Hope that helps you.
Apple sauce coming in hot. So here's what it is. FHA, 580. Fannie Mae, 620. Freddie Mac, 620. VA, does not matter. You could have like a 500, we can still move forward. FHA, if you're putting 10% or more down, 500.
He said what you need.
What I need. I need me an 848.
800 and above, man. That's what you're working towards.
That's what you'd like. Yeah, that's what we like. Hey, I saw a lot of loan officers today. I was going through TikTok, and there's a lot of live loan officers. I couldn't believe it. I've seen some people actually putting it out there and going live, and I was kind of happy about it.
Alfredo Garcia, when you first purchase a home through a lender, is it the first year covered in case something comes up?
Good question, Alfredo Garcia. So he's like, hey, I'm going to try to use my username, Alfredo Garcia 01. Nope, 02, 03, 04. 6. We got the 6,411.
6411. Maybe he likes 64 Impalas and he's born on the 11th.
So when you buy a home from a new build, sometimes, most of the time, they come with a 1-year warranty, and you kind of got to pay for it. It's a weird little section of the new builds. In a already built house, once you buy it, you own it. So all the problems that come with that house, you own it. This is why the inspection period is very important. However, you can buy insurance. You can buy insurance for a year or 2 years, and you can even negotiate that into the contract. You can say, hey, listen, I will give you the $500,000, but I need you to buy me an insurance contract that if something goes wrong, this thing is covered. So yes, do we do loans in New York? Yes, we do it in New York. All 50 states. All 50. He likes to sing.
Jungle, what dreams are made of.
Is that Rihanna?
That is Alicia Keys.
Alicia Keys.
Yeah.
Alicia Keys.
North Carolina, not New York.
North Carolina. No. Oh, you're right. North Carolina. Applesauce. We do New York. We do North Carolina. We do Miami, which is in Florida. We do Tennessee, which is in Tennessee.
Garcia, man.
Oh, what happened? What happened?
You
What happened?
guys are awesome. I love what you do.
We
God bless
appreciate
you.
you. We appreciate you. Hey, I've actually seen some other loan officers doing what we're doing. They're finally started, and that's kind of cool. But we're trying to keep ours entertaining. We want to keep it entertaining. I was a little bored with the ones I was watching. I was like, guys, you got to have a little bit more to this. Got to have a little more punch to it, or else you're going to lose your entire audience. We try not to lose our audience. We talk about. What are you talking about? Got. Somebody got.
That's what the kids say nowadays.
Yeah, they got. They done got. Okay, cool. So we are, by the way, CPI came in yesterday. Not very good. It's kind of horrible. Mm-hmm. Like, really bad. Like, really, really bad. And because of that, rates jumped. Not a little bit. Kind of a lot. There was a while when I was saying, hey, you can get a 5.375. Can't do that anymore. There was a time when I was saying you can get a 5.5. That's what New American Funding was saying anyway. Can't do that anymore. If you went to the website, you'd see 5.875, and 6. What? 6. And I just priced a conventional at 7.99. And it's not a bad rate either. It's kind of weird, but because of the scenario, 7.99. And you know what? A conversation I had with that client, I said, hey, listen, it's not a matter of whether you're going to refinance. You're going to refinance. You're going to. We have to do it strategically. That's all.
Apple user. I'm not going to call you Apple Sauce. I'm going to call you by your real name, Apple user. So here's the thing. You got a 552 credit score. 1, how do you know that? Where did you get it from? 2, we got to get that score up. So you're not going to be able to touch a loan unless you're coming in with a significant amount of money, okay? A significant amount. But if we get that thing at a 580 or above, there's an opportunity where you can get
Diamond Nails, great to see you.
You can put the minimum
Seamus.
payment down. Okay?
Koa.
So here's what you're going to do.
Dilla Bus.
You're going to get a hold of us. We're going to get you your real credit because I'm going to assume that came from Credit Karma or one of those apps, okay, which uses FICO 8.
Eliso.
We use FICO 5 for mortgages. So that score is probably closer to 500, which means we're going to need to probably put you in credit repair. Mortgage Solution gave it to me. What's Mortgage Solution? Is that an app?
No, Mortgage Solution is a big bank. It's a lending company like us.
Mortgage Solution?
Yeah, Mortgage Solutions. Yeah, they do a lot of advertising on the radio and stuff like that. Yeah. Yeah, not a fanboy. Not a fanboy. I beat them. I beat them all day long. They actually originated out of Colorado. I know their story.
Okay, cool.
They originated out of Colorado. Decent company. Yeah, decent.
So do they give you advice on what to do to get that credit score?
Yeah. There's a LO from Mortgage Solutions who comes on lives and does lives. Yeah. That's probably where they got them. So anyway, no worries. What you should have gotten is if you got a 552 FICO score, first off, ask for the copy of your credit report because you should be able to get it. And then you'll know what people are seeing. Because here's the problem. You're like, hey, I don't know my FICO score and I don't know what people are seeing. You're going to be surprised to realize that it goes all the way back 10 years. I can tell 10 years ago if you were late 30 days. I can tell you that 6 things were late 4 years ago in June. And you'll be like, well, that's when somebody passed away or something happened. Okay, cool. Well, then I learned how to deal with that. And we help you moving forward to build a plan to get your credit up. Because credit is super important. Okay, when do I call you? Me and my wife are looking to get something in a year or so. You would call us in about 1 hour. 1 hour. What phone number would you call us at? This one right here. 1 hour. 1 hour. And then we'll go through the process and we'll help you get your credit score up and get moving forward. Now, tell me about what you know is going on in the financial worlds.
In the financial world?
Yep.
I know that in the 70s, okay, in the 70s, traditionally, you had one income household, okay? So dad went to work, earned all the money, and in the 70s, inflation hit really hard, and that was the introduction of the mom starting to become the 2-income household, okay? And we've maintained that for the last 40 years. So for the last 40 years, very common for husband and wife to both work to support a family. So during this time, it's been pretty comfortable for most, but now it's getting very tight. And more than ever, we're seeing people, families, husbands and wives getting 2 jobs in order to just make ends meet and then adding a 3rd job in some situations. Now, the data that's put out there is not accurate because when you talk about, or when you hear our government talk about, hey, we're creating jobs, we're creating jobs, we're creating jobs. What that is, what a lot of that is these people getting second jobs. So they're not really creating jobs. It's dad that works at, let's say, Amazon 40 hours a week and then got a part-time job at Kentucky Fried Chicken. So now he's working part-time at
Why did you have to go to Kentucky Fried Chicken?
It's delicious.
You could have gone to 31 Flavors.
That's delicious too. So mom got a job at 31 Flavors.
Oh, I got you.
So when they talk about jobs being created, it's not jobs being created. It's these struggling families getting more jobs to create more income just to make ends meet, just to get the same amount of food on the table, just to pay the mortgage payment, just to put gas in the car. So as far as the financial sector is concerned, it's pretty effed.
Yeah, it's not a good situation, but we can teach you how to hack the system. Hack it as much as it can be hacked anyway. There's the way, you can do something and then you can do something exceptionally well. We'll teach you how to do it exceptionally well. Apple user, you said you did an application at New American Funding about 6 months ago. Who was your loan officer?
Yeah.
Who was it? Because the banks, here's something that one of the LOs I was watching said this, and it's pretty accurate. He said, hey, listen, it's not just the bank you're dealing with, it's the loan officer that you're dealing with. Here's why. Fannie Mae, Freddie Mac, they all have the same guidelines for everybody. Same guidelines for everybody. Everybody has the same guidelines. Okay, everybody. It's like a surgeon. Surgeon has the same tools. Now, question is, why is one better than another? Because they know how to use the tools better. Now, inside of that, everybody has the same guidelines. If you're a smaller bank, they'll put a little overlay on top of the guidelines, which makes it harder for that smaller bank to fund a loan. Those are called overlays. Now, if you're dealing with a very large bank, you don't have to worry about overlays. But if you're dealing with a lower level bank, overlays are very important. But your LO, loan officer, should know what the hell they're talking about and should not be afraid to put it out. Because if they actually fund loans, then we can quote the guidelines like that. We do all day, every day. We've been doing this for over a year. Well, we've been doing the social media thing for 10 years, for probably 10 years, when Facebook just started and Instagram wasn't around yet and TikTok wasn't around yet and all these things weren't around yet. We were actually doing the social media, putting it out there because we actually fund the loans and we can help you. We can help you with the hacks. I can teach you how to get your credit score up fast, like fast. People are like, hey, should I refinance? Somebody hit me yesterday. Is a VAIRRRL a real thing, and will it work right now? And the answer is probably not for you. Why? Because interest rates are higher right now, and in order for VAIRRRL to work, rates have to be lower. They have to be lower. You can't just refinance because you want a cheaper payment. That's not the world we live in. They have to be lower. So there's a way to do all of this stuff. You go.
Holly Falcon in the house. Is PMI on every loan without putting 20%, or is there any way around PMI?
Holly, do you want to know why? Let me ask one more time. Do you want to know why? So, yes, there is a way for you to not have mortgage insurance. There's a way for you to not have mortgage insurance, and that is be a veteran. Okay? So if you're not a veteran, you're going to get mortgage insurance if you put less than 20%. But here's why. Here's the real reason why. So if somebody's borrowing against a house, there's a probability that they will default on the loan. And the only one who's going to get hurt is the bank. I know you think the borrower is going to get hurt, but they're not. They're going to walk away, move on with life. The bank is going to have to foreclose, get the squatters out, clean up the house, put it on the market, pay the realtor, and then they're going to get hurt in this process. So what the system has designed is we're going to make the borrower pay for insurance for the bank. Wait, what? For the bank. You're forced to pay insurance for the bank. Now, if you go with FHA, it's pretty steadfast. It's what it is. It's 0.55 at 3.5% down. If you put 5% more down, it's 0.50. It's just a set rate. So that's your MI on an FHA. But if you do a conventional Fannie Mae or Freddie Mac, and you want to put less than 20% down, now your credit score becomes super important. Why? Because if you have an 800 credit score, I could very possibly price out MI and come in at 0.21. But if you have a shitty credit score, and I say shitty at 622, I could get MI at 3.2, which is a gigantic difference. Gigantic. So he talks about this all the time. Credit is so important. So important. And it's not important just from the interest rates, because the interest rates are in this range. It's also from the MI perspective. Because if you're only putting 5% down, MI becomes a very important, sometimes expensive part of the loan.
Here's the thing, Holly. I want to add to that. So most people that are asking questions like, hey, is there a way around PMI? Is there a way around not having to pay it? Is there a way around putting less than 20% down and not having to do that? Here's the truth, is that you're in that sector, okay? You're in that phase. And my recommendation is get in, accept the MI for what it is. Many people do this. I would say probably 90% of our loans have MI. Okay, 9 out of 10 loans have mortgage insurance. Now, the mortgage insurance is not permanent. You're actually in a very unique time period in real estate where we can almost predict what's going to happen in the future because we've seen what happened in 2020. So the Fed has already announced that there's going to be 3 reductions in interest rates this year. Okay, so as the interest rates start dropping, the values start pumping up. Now, as the values start pumping up, it's going to open up the amount of equity in your property. So let's say you put 10% down, okay? So you have 10% to make up to try to get rid of that mortgage insurance. So what you'll do in about a year or two, when rates bottom out and values top out, you're going to have all that equity. So when you refinance, you're going to be able to drop the mortgage insurance by dropping the interest rate. And with luck, if you have enough equity, remove the mortgage insurance. Very rare. Most people take some 10, 15 years to accomplish this, but you'll be able to do this in the next 10 years based on what the Fed has already put out. So you're in a good spot.
It's a very good spot. It's actually a very good spot. What are the interest rates right now? If you went to the New American Funding website, 5.875. That is not your quote. The only way I can do your quote is to pull your credit, calculate your income, check your assets, then I give you your quote. But New American Funding is putting out 5.875. Don't believe me? Go to the top links where it says cool stuff. Today's interest rates, you'll see what I'm looking at. 5.875 on a 15-year fixed, 6.0 on a 30-year FHA, 6.0 on a 30-year VA. Now, that every time I do a loan, every time we do a file, the pricing is going to change. It changes like daily, like hourly sometimes. So I quoted one just a minute ago, high, like $850,000 house at 7.99, and that was a good rate for that file. It was a good rate for that file. So everybody's rate is going to be a little different. It's going to be in this hovering range. But most important part, FICO score.
Look at, just came in.
FICO score, pricing, price improvement.
Yep.
Great.
Just came in during this.
During this.
Yeah. Holly, so buy now before that happens. Don't wait for that down interest rate.
Holly, yes, and here's why. Okay, so you have to look at the macroeconomics. Step back far and go, okay, cool. What's going to happen in the future of the United States and the economy and everything? Well, this guy, his name is Jerome Powell. He's the chairman of the Federal Reserve. They are the ones that dictate the direction of the economy. They don't drive it entirely. A lot of it is driven by market forces, but they get to put an input on it, and they kind of drive it in a certain way. Like, for instance, they told us 5 years ago that rates were going to go up, and they did. They very predictably did. They said they were going to go up pretty damn fast and pretty damn high, and they did. They said that we believe that we're going to be in the 5.5% to 6% interest rate from a Fed perspective by the 2023, and we did. It was that predictable. And you know what? We're like, I don't know. Yes, it happened. It happened. But these same people, Chairman of the Federal Reserve and the entire Federal Reserve Board, that's them. You can find it if you want the picture. I'll send it to you. But here's what they are saying is going to happen over the next 2 to 3 years, okay? All 12 members say they're in a consensus that say we should be at 5.25 to 5.5, which is right now. This is right now, 5.25. Now, as you go into later of 24, into 25, into 26, and into 27, that's 2 to 3 years from now. 24, 25, 26, 27. 4 years, kind of. But if you watch this, their consensus, they land at 2.5% at the end of 26, beginning of 27. So that's the Fed funds rate. That's not the mortgage rate. The mortgage rate is based off the 10-year yield, okay? And usually there's a 150 basis point, 100 to 150 basis point spread from the 10-year yield to the mortgage rate. So what does that mean? That means that we're at 5.5, do 150 basis points at 5.5, and you're going to go 6.57. So our rates are hovering in the 7s. Perfect scores getting the 5s, not so perfect getting the 8s. So that's kind of where we're at. So if you take this forward to 2.5 in 2026 and 2027, the rates are going to go down. Now, every time this thing ticks down a little bit, a whole bunch of new borrowers enter. Whole bunch, not a little bit, a whole bunch. It's called pent-up demand, and we know it's ridiculously high, especially from because we do qualifications all the time, and they're like, hey, I can't buy right now, but as soon as they go down, I'll buy. And I'm like, yeah, it's better if you buy now. It's better. Why? Here's why. Because if you have a house on the market right now for $500,000, there's not a lot of buyers out there. Not a lot. And because there's not a lot, it is a buyer's market. The buyers get to dictate the terms. They get to say, hey, I want you to cover some concessions. I want you to reduce your price a little bit. They've got that kind of power. The buyers do. It's a buyer's market. But as soon as 50,000 borrowers enter the market in every market, now that $500,000 house is going to have 10 offers the first weekend. It is now a seller's market. And the seller can say, I'm not reducing my price. I'm not covering any closing costs. You're crazy. There's someone right behind you who will pay me full price and give me all closing costs. And then the market starts going up because of demand. It's not rocket science. It's actually pretty simple math. You just have to be able to take a look at it, understand where we're at, and understand that this is going to happen over the next 2 to 3 years, and it is going to go down. Prices are going to skyrocket. I believe. Anyway.
I'm loving the questions this morning, guys. There's a lot of good energy here. I need you guys to help us, though. Help us get to 10,000 likes. So start liking away. Get us to 10,000 likes. What that'll do is it'll invite more people in here to keep asking these awesome questions that help a whole community, okay?
So let's make it a fair exchange situation. If we answer your questions and we give you a good answer, give us a few likes. How about that? If we give you a good logical, sometimes you're not going to like the answer, but we'll still give you an answer. When somebody says, hey, can I get me a house with a 540 FICO and 3% down? My answer is going to be, no, you can't. Don't be ridiculous. Now, that person's probably never going to come back to my live again, but before they go, at least they can like me up for being honest. Right? Right? Okay.
Lane, is there a loan to build? And we're going to get to every one of your questions, guys, so just hang in there. We'll get to all of them. Lane, is there a loan to build?
Yes, there are. There's it's a very complicated loan. It's called a VA one-time construct and an FHA one-time construct. Those two are, but it's difficult. It's not something that's simple, and it's going to take a year or two, and I've never seen one successfully pulled off. Now, there are some where you can put a modular on a land, and then you can do that under a VA construct loan and an FHA construct loan, but that's very difficult too. So do they exist? Yes, they do. Would we help you with one? Yes, we would. Do I recommend them? Hell no. Hell no. No. But if you really want to do it.
User 6213. This one's a little disturbing.
All right, cool.
I'm finally under contract to sell. Buyer is pre-approved VA loan. Should I start shopping next house?
I'm under contract to sell.
Yes. I don't think you have a whole lot of communication or direction from your agent right now.
Yeah.
This is a big deal because you could be homeless here unless you're trying to stay with parents or something. Yes, you should be pre-qualified already. You should be shopping for your next home, and that'll be a contingent purchase, okay? Your agent should already be guiding you on this. Let me know if your agent has any communication under this certain situation.
It's called a contingent offer, and by the way, I'm actually doing one right now where I told, hey, I need a net sheet from the departing escrow so that I can report it to the procuring escrow, because these two need to talk to each other. If they don't talk to each other, you'll mess up the loan in the process, because you can't say, hey, listen, trust me, bro, I'm going to sell it. All right, show me the legal contract. Because if not, I got to hit you for payment, property taxes, insurance, whatever else is out there, HOA. And if you just say, trust me, bro, it's under contract, can't you see? It doesn't work like that. There is an escrow with full legal paperwork. And I have to say, hey, listen, I need a net sheet. Net sheet says, this is what we're selling for, this is what we got to pay off. After everything, this is what we're going to net. Basically, that's what it means. It's not exact, but it's close. So I'm going to need a net sheet from the departing residence, and I need to be able to put it into the escrow for the procuring residence in order to make this thing flow smoothly. This is why he's saying this is something that your realtor and your loan officer should be working with you every step of the way. And if they're not, replace them today.
Wow. How will they do that? Time for commercial.
Oh, if you need a badass loan, call Badass Loan Officer. You can reach your badass loan officers, Chris and Lee, at the numbers on the screen, and we will help you every step of the way. This will disappear in 5, 4, 3, 2, 1, bye.
And if you're ready to get started and don't want to talk to us, go to the link in our bio, click on apply for a home loan now. You can start it while we're sitting here. We'll call you when we're done.
Holly, we're here for you.
You're welcome, Holly Falcon. Welcome.
You know what? We actually have people that come onto our lives that jumped on the live 3 or 4 months ago, were in trouble. We help them, put them in a house. They jump in to tell them, hey, these guys are great. It's amazing. It's amazing. It's kind of cool to go from just met you to you now have your own house.
Yeah.
It's pretty darn cool.
Peachy, hi. Do you know anything about assuming mortgages, pros and cons?
Peachy. Most of the time, not a good idea. And here's what happens a lot. VAs, and there's a lot of kids out there going, hey, you could buy this subject too. It's a crapshoot. And here's why. I had a veteran call me and they said, hey, Lee, they want to assume my VA loan. What do you think? And I said, are they a veteran? No. I said, I think it's a stupid idea. Do not do it. But they're saying, but Lee, they're saying they'll give me a little bit more. And I'm like, yeah, it's still a stupid idea. Do not do it. Why? Because your VA entitlement is tied up in that loan. And if you do not release it by paying off the loan, you are never going to get that back until that other person pays it off 30 years from now. That's when you'll get it back. Till then, doesn't matter. You used it. You gave it to somebody else. Stupid. Most banks won't approve it, but the VA does not prohibit it. So it is doable, and there's some low-level banks that will do it. Now, if you're assuming your husband's loan, then maybe that's an okay situation because you're legally married and you're already considered one person in the eyes of the law. In that situation, it might work, maybe. But if it's a stranger, if you're the stranger that's trying to do, I tell them, no. It's some kid trying to make money off of you. Don't do it.
There you go. Lane, is there a loan to build a loan and include all current debt in the new loan?
Lane, remember, I told you I'm going to give you answers, but you have to hard us up for being honest with
10,000
you.
10,000 guys.
Yeah, 10,000 likes.
likes.
Lane, here's the answer. Not a snowball's chance in hell. No. They're like, hey, you know what, bro, I want to buy a house. Can you throw in my credit cards, my trip to Fiji, my automobile, and, oh, by the way, did I tell you I want a new BMW? Let's throw that in there too. Can you just wrap it all up and maybe I'll just pay you every now and then? No. Just no.
Okay. Trevor Rocket, 6 on a 30-year. LOL rates just went up a quarter point yesterday.
You're correct, man. You are correct. They're going up crazy amounts. And we put out what New American Funding puts out. It says 5.75 on a 15-year Fannie Mae, Freddie, on a conventional 15-year conventional 5.75. Don't believe me? Go to the top links. Go to cool stuff. And then you'll see today's rate. This is what New American Funding is putting out to you. It's not my quote to you. The only way I can give you a quote is to pull your credit. Check your income, check your assets, then I give you your quote.
Wow, we're at 2,000 likes. All right, only 8,000 to go, guys. Keep liking. Nikki Luxury Travel. I just got hammered on an interest on a $766,000 loan in a second home tier 1 credit and 20% down, 7.65 rate, and had to pay points for it.
Yeah, Nikki, that's kind of the market we're in. Here's the thing, Nikki.
Second home.
Nikki. Here's what I want you to realize, okay? This is very important because this is macro strategic planning. Remember, if I give you your answer, heart it up, whether you like it or not, heart it up. So, Nikki, here's the thing. When I'm priced somebody today and I said, hey, listen, you're buying an $800,000 house, your price is the best rate I can do for you right now, even with the buy down is 7.99 right now because of their scenario, their big high dollar price, high big house. I said, the best I can do for you is 7.99. And she goes, Lee, do you think that's good? I said, no, I think it's horrible. It's horrible. I also think it's the market because I priced 14 different lenders and that's the best one with the point buy down. But here's what I want you to think, Mr. and Mrs. Smith. Mr. and Mrs. Smith, it's not a matter of whether you will refinance. You are going to refinance. That will not be your permanent interest rate. We are going to do a strategic refinance. And I'm not going to be calling you every 6 months to refi. I would make a lot of money if I did, but I'm not going to do it. I'm going to tell you where the market is going. I believe it's going. And I'm going to back it up with data from the FOMC, from the chairman of the Federal Reserve, from the direction of the economy, and then I'm going to tell you roundabout when you're going to refinance, and I want you to save your money because when you do, I want you to spend a fortune and buy those points as deep as you possibly can and then never touch it again. Because if these guys are correct and we go to 2.25 on the prime, 2.25, well, if you just run the basic math of the last 100 years, there's a 100 to 150 basis point spread between the 10-year yield and the mortgage rates. 2.25, 150 basis points is 4%. So we should be somewhere in the 4s. If you're in the 4s, you can buy to the 3s. If you buy to the 3s, it's not going to be cheap, it's going to cost you 20, 30 grand. But if you buy to the threes, you now have 3% interest rate for the next 30 years. The only downside of that is you're going to have to pay for the refinance, and you have to start your 30-year clock over again. So we have to factor that piece in. That's why I don't want you refinancing every 6 months. So there's the facts. That's the reality.
Holly Falcon, that was the best explanation I've had. Thank you. You're welcome. Do me a favor. Give us about 4,000 likes for
4,000. Can you do 4,000 likes real
quick?
quick?
Call us when you're ready.
Yeah.
User 6130. I already answered that one.
Okay, cool.
Best must have daily said 5K. I don't
5K.
know what
I don't know
that
if are you trying to give us 5K? Are you trying to give us 5K?
He's going to give us 5,000 likes.
We like you. Best must have daily 5,000 likes. We appreciate you so much. Betty Bay followed the host. We appreciate you.
Yeah.
Is it a bad idea? Go ahead.
Is it a bad idea to open a new credit card when I'm getting a home in a year from now?
No, probably a good idea if you're waiting for a year from now. We do look at multiple trade lines. We want to see a responsible amount of trade lines. You could have 10, but you only use 3 or 4 of them. That's a responsible amount of trade lines. Also, we want to see that you're not maxing the trade lines. What does that mean?
It means that let's say you get a credit card that has $1,000 limit. Okay, $1,000 limit. This bank said, hey, your credit's good enough. I'm going to let you $1,000 credit limit. Okay, and then you max it. Okay, you take it to $1,000. That tells them that you don't have any discipline. It sounds silly because they let you do it. They said it was okay. You're going to pay for it. But that tells all the bureaus that, hey, when this person gets something, they just max it out the gate. So what that does is it pushes your scores down. Okay, so the higher the balance, the lower the score. The lower the balance, the higher the score.
Peachy, we're not going to ignore you. I don't know what question I missed, but we're going to find it. She says, hi,
Peachy,
we missed your question.
what are you talking about? We don't
roll
do that.
Roll up or miss a question. We're not going to miss Peachy's question. I like the name alone.
Up.
Peachy.
All right, you know anything about assuming mortgages? We answered that one.
Yeah, we did. Yeah, pros and cons. Yeah, if you assume, I don't know. For the most part, I do not recommend assuming a mortgage from either side. And there's a whole bunch of these cute little kid gurus are running around going, hey, you could buy subject to and become a billionaire. Yeah, you're screwing people over when you do that, and there's stuff that will hurt you and hurt the seller and hurt the buyer, and this person doesn't give a shit because they don't have a license and they don't have a bar to recommend. Because if you're a realtor, you've got a broker that has an E&O license or an E&O insurance policy for millions, like literally millions. If you're a loan officer, there's an E&O insurance policy for millions. But if you're talking to this kid on TikTok who's going, hey, assumable, you can assume and become a billionaire by next week. He doesn't have any license. He's got no skin in the game. He might make a profit by scamming somebody with a smooth talk, but it's crap. It's junk. Assuming, most of the time, no. Was that good enough answer for you, Peachy?
There you go. Victoria Smith, right here. She said, thank you, realtor here, and I tell my sellers all the time, and they don't believe me. Badass realtor here is Victoria.
Victoria, we like you already. We like you. We will tell you. We tell clients all the time. And by the way, there's this new thing because of the NAR lawsuit. There's a lot of people that are coming out against realtors, and I'm for realtors. I'm for them. But here's the reality of it. Do you like paying for your car insurance? You don't. I don't like paying for my car insurance. I don't. I hate it. I have full coverage on all my cars, and I got a lot of them. It sucks until I'm in an accident. And then everything gets covered. All medical gets covered. Everything gets covered. But the only time I really know the value of it is when something really goes wrong. And the only time you know the value of a good realtor is if something really goes wrong. So I'm a big fan of realtors. Big fan. But there's a lot of people hating them, man.
You're making me feel like I shouldn't be riding with you, man.
All right.
You're making me feel like you're a scary driver.
I am a little
Victoria
bit
Smith, do me a favor, screenshot this, reach out to us, let us know what market you're in. Let's work together. We got clients across the nation. Maybe we can send you something.
Bay. Hey, what's up, Bay? Hey, Bay. What's the advantage of a down? What's the advantage of dawn payment assistance? I'm gonna assume that because you called yourself Bay, B-A-Y, that your dawn is supposed to be down. So what's the advantage? Here's the advantage. It's simple. They give you down payment assistance.
Boom.
That's it. See how simple that was? They give you down payment assistance. If you want to know what the disadvantages are, ask that.
He'd rather talk about the negatives. So go ahead and ask him the negatives. Victoria Smith, you need a lot of cash to assume. Yeah.
Sometimes, yeah. Sometimes,
Worst
yeah.
idea ever.
Yeah.
It works in a very small percentage.
There's a few scenarios where it's a good idea. I'll give you one. You want one? You want one? Ask me. Say, Victoria, I want one of those scenarios. Here's the scenario, okay? Here's the scenario. You get a person, we'll call him person A, and he wants to buy a house, but he can't qualify. He's just out of range for qualifying. So he goes to his mom and he says, hey mom, will you co-sign for me? And mom says, why, yes, loving son, I will co-sign for you. And now you qualify for the loan. All right, cool. So now he's been in this home for 3 years. He's been in this home for 3 years. Guess who's on that loan? Him and his mom. Both of them. They're both on the loan. Guess who owes that loan? Him and his mom. But in those 3 years, he's worked really hard. He's got managerial positions. He makes a lot more money, but they got a good interest rate because they did it 3 years ago. Now, they say, hey, how do I get my mom off? Well, a loan officer who's only looking at his pocket will say, refinance, let's do it, refinance. Why? Because I make 5 to 10 grand if you do that. But somebody who actually is playing the game for the consumer says, hey, why don't we try and let you assume that loan? I can't get involved as a loan officer because you don't need me. But you call the servicer and the investor and see if you can assume that loan. The servicer is going to go, all right, we might let you assume it, but you have to qualify on your own. You cannot qualify with your mom anymore. So now this guy says, person A says, hey, great news. In the last 3 years, I've gotten management positions and I make 3 times what I used to. The servicer says, you do qualify for this. And because of that, we're going to let you assume that loan. Your mom is no longer on it. And that's the scenario where it works, but it's rare.
Yep. So, Fancy Mexican, thank you for the love.
What's up, Fancy
Mexican? I like the fancy ones.
Fancy, huh? You
Maria.
fancy, huh?
Well, in the Chapter 13 bankruptcy, is it best to get approved from the trustee first for an FHA loan? Maria, almost like Miraca. In Chapter 13 bankruptcy, there's some really clean guidelines. So Chapter 7 is, hey, screw it. I'm walking away from everything. I don't care. Let the system pay my bills. That's Chapter 7. Chapter 13 is, whoa, I got a little too deep. Can Mr. Judge, Your Honor, can you reorganize this so that I can pay it off? So Chapter 13 is a responsible way to deal with you got yourself in too deep. That's Chapter 13. So the guidelines actually favor you and they say, hey, listen, if you've been making your payments on time for a certain period of time, we will let you get a loan while you're in Chapter 13 bankruptcy. Doesn't even have to be discharged. Boom. Okay, cool. All right, guys, a lot of good questions in here, but I'm going to change it. We're at 4,000 likes. Let's get it to 20,000.
He made that stuff up. Who made that stuff up?
Let's get it to 20,000, guys. Let's get it to 20,000. Keep liking. I like it. We got to get more people in here to ask these questions. These are good questions today. Camacho just gave you 1,000+ likes and going. Don't know if you can see it.
I appreciate you, Camacho94. You badass. You the man. Anytime we can help you, Camacho, we're going to help you.
Yes, I did save your info. Let's work together. I need lenders who are honest with my buyer.
Boom, right there. Sometimes you won't like it, though. Sometimes they're like, hey, what should I do about this? I'm like, here's the reality.
Look for another buyer.
Yeah, here's the reality. Yeah.
Best must-haves daily. Thoughts on DSCR loans?
Best must-haves daily. DSCR loans are amazing for the appropriate DSCR scenario. Amazing. What is the amazing scenario? You have 20% down. It does debt service. You actually can handle a management fee inside of that debt service. And you're walking into a very good equity position. In that scenario, they're amazing. They're amazing. Here's the problem when they're not amazing. People try and make them fit into a scenario where they don't fit. That's when they're not amazing.
Yeah, and it's not the easiest because DSCR loans need a debt service, guys. So the rents in the area have to match or exceed what your mortgage payment's going to be. And with today's rates, a little difficult. That being said, they're still being done. Yeah. They're needles in a haystack, but you can get that.
But let me give me one more piece there. You know what? If you go to Southern California, look for a DSCR, forget about it. It's not happening. If you go to Florida, not happening. New York, not happening. Chicago, not happening. Any places.
Midwest?
Midwest may be happening. Yeah. Maybe. So if you're looking for a spot where you're going to get a high value piece of real estate and try and DSCR it, not happening.
All right, 20,000 likes, guys. Keep working on that. Franzi M595, does it make sense to get an equity loan, second mortgage, use the funds to pay off debt, and rest for down payment on a new home?
Maybe, Franzi. Maybe. That is a situation where maybe it will work. And The reason that might work is because let's just say you have an automobile and you've got 18 months left on it. It's $1,000 a month. And you have 18,000 that you can do. That $1,000 a month is going to eat up your buying power for your second house. But if you cash out refi, or better yet, HELOC or second mortgage or whatever you choose, you take the money out and you pay that 18,000 off. You now got buying power. So you will affect buying the second house by doing that. Not in all cases, by the way. Not in all cases does it make sense. Everybody's scenario is different.
We're going to get to every single one of your questions, so keep loading up the questions, guys. We've got other platforms we have to address, too. Over here we have, what are the parameters for a brand new buyer never owned a home before?
Oh, what are the parameters? First off, you got to have big eyes. You got to go, I want to be a homeowner. Yeah. You got to have a positive mental attitude. Say, I can do it. I can be a homeowner. I can do it. Yes, I can. Wake up in the morning every day, look in the mirror and say, you know what? You're good enough. You're smart enough. And darn it, people like you. You're going to be a homeowner. So that's the first scenario. Next thing you do, call us. Because when you call us, we're going to pull your credit and we're going to find your income. And we're going to tell you what you qualify for right now. Now, that may not be the answer that you want right now, but it gives you a starting point. And you say, hey, Lee, I've only got $7,000 saved, and I want to buy a $300,000 house, regular FHA. I make about $70,000 a year, and I live in the Midwest. All right, I'm going to tell you, hey, listen, good news. You don't qualify right now. What do you mean that's good news? Because you're only about $2,000 or $3,000 in savings away, and then you do qualify. What? Yup. Instagram. I hope you heard that, because that's going to Instagram.
Yeah. Victoria Smith, thank you for the love and the follow.
We appreciate you.
Maria. Yes. Do I want until I reach my 12 months to start shopping around? I'll be a year in November. This is chapter 13.
So chapter 13 is going to do some very strange things to your credit because you're in bankruptcy and everybody knows it. The credit reporting agencies know it. So you need to start to build up that payment profile. Do not mess up. I can't stand when I see somebody do a 7 or a 13 and then as soon as it's discharged, they got 30-day lates. Because the underwriter looks at that and goes, how responsible have they been since they walked away from everything? And I'm like, well, they've only got one 30-day late. Yeah, Lee, one 30-day late, 3 months after the discharge. We already know what type of borrower we're dealing with. I have to fight that. I've had to fight that many times. So make sure you make those payments on time. And should you start looking right now? Well, I would make sure that your payments are in line first because we don't have an accurate reading on your credit score. We'll get a false positive. False positive means it looks higher than it really is because we haven't factored everything in. So it won't be real if you start right now. You can start, but it won't be real. We can tell you from your income what you'll qualify for, so that's a thought.
All right, other platform. I think that's Facebook. Mm-hmm. I know I have bad credit. I made a lot of mistakes when I was young. What can I do to get me on the right track?
So, good question. Very good question. So, if you messed up when you were young, if you messed up, we all did. I did. I tell you stories. It's hilarious. So, if you messed up when you were young, and I think we all do sooner or later, first own it. That's the biggest issue I have is when somebody's like, well, Verizon screwed me over because they are screw over people. And so did the electric company. They lied and they screwed me over. And these people, nobody gives a shit. You screwed up. All right, cool. You screwed up. Cool. Just own it. Yeah, I didn't do things correctly 4 years ago. All right, cool. That's full. That's you own it. All right, own it. Second, can we get these things deleted? It may be that we can get them deleted. That's an option. Third, how are you doing right now? Some people are like, well, I don't get no credit cards, so I'm doing great. I don't have no credit cards. I'm like, that's not great. That's actually horrible. What do you mean horrible? That means I have 800 credit score because I don't have any credit, any liabilities. No, it means you don't allow people to trust you with debt. And because they don't trust you with debt, we don't know how you handle debt. If you have 8 credit cards and they're all paid on time or there's 0 balances, then we know how you handle debt. But if you have none, you've just said, hey, I don't trust myself. Neither does anybody else. Give me a house. No, it's not how it works. So if you've got messed up credit from you were a kid, first own it. Second, let's see if we can get rid of it. And third, pay your stuff on time and learn how to manage this stuff because you're going to need them as a grown-up.
And depending on how damaged it is, depending on how soon you want to be a homeowner, you may need credit repair. You may need an expert to hop in there and do it. I'll let you know that inside of 6 months, I've seen credit go from 450 to 650. 6 months. So 6 months from
That's
now
a good.
is October. So
Yep.
possibility that if you're in the 400 or 500s, by October you guys could be shopping for a house. Halloween you could be in your house. So keep that in mind. And if you do need credit repair, go to the link in the bio, click on Fix My Credit, and get that process started.
In Halloween, you can be holler.
You can actually give out candy from your front door, your very own front door.
Very own front door. I own this bad boy. That's my Snickers bar.
Best must-haves daily. Appreciate both the honesty and insights. You're welcome.
You're welcome.
Is there
By the way,
something-
if you're a loan officer on here, I don't hate you. I love you. Come on board.
the
Hit me with
scenarios.
guidelines. Hit me with the guidelines. I saw another loan officer who saw me because my name, not this, the Kristen Lee team, but my name says finance man in it. Like literally says finance man in it. Lead around the finance man. It's what it says. So I saw, once I logged in, I saw this nervous thing going, there's another loan officer checking me. I don't give a shit. Check me. Join on board. I don't care. If you think you're good enough to get clients, get some clients. Be honest. Help people. That's how you build a bigger picture.
Alma Ortega, I have a low credit score. How do I get better, and what do I need to qualify for a $280,000 loan?
Well, it's going to depend on what your low credit score is. If you have a 584 and you think that's a low credit score, we might be able to qualify you FHA. Maybe. See that thing set there's 580. If you have a 624, or some people think a low credit score is under 700. That's what they think. Once we know what your credit score is, then we can put together an action plan. Some people think good credit is 502 because it used to be 448. No, that's relative. 502 is not good credit.
596.
596, which means you probably do qualify for an FHA loan. But one factor, a little asterisk, here's the thing. If in the last 12 months you've been irresponsible with debt, in other words, you have 30-day late, 60-day late, 90-day late collections, anything like that in the last year, well, you're not fixed yet. We got to fix that. I might be able to get away with 1 30-day late, 2 30-day lates with that credit score, done. So we do have to take a look at it. We have to find out what's going on. If they're older than 12 months, then I need an LOE. LOE is letter of explanation. I got to explain why. We're not saying you didn't do it. We're just saying, hey, listen, I lost my job for a little while. Couldn't make payments. Got a new job. I make payments now. Cool. That explains it. The underwriter can put their head around it. Yeah, we all lost a job at some point. I know what that's like. It sucks. Cool. You're better now. Things are great. There's a real human on the other side that's underwriting your loan. And if you can make a case, they can give you the loan.
Yeah. Juan Guzman, thank you for the follow. $900 a month. Debt. 580 credit score, makes $75,000 a year. Do I qualify?
You take that.
So the answer is maybe. You meet the guidelines. You absolutely meet the guidelines because our financing for FHA starts at 580, so you're right on the line. It's going to depend on where you get that credit score from too. Most people are getting their credit scores from Credit Karma, from the apps on their credit cards. They're getting them online, freecreditreport.com, and those don't necessarily follow the mortgage credit scores. So what I'm going to recommend is we need to figure out what that real credit score is by giving us a holler, and then I'll let you know how much you can qualify for.
What if Juan Guzman's a veteran?
If Juan Guzman's a veteran, same thing. I still don't know what your credit score is, but if you meet the back end of the residual, which is the mathematical equation that we do on a VA loan, and there's excess income there, I'm telling you things that you probably don't know, but we do, then yes, you actually probably do qualify if you have a VA loan, if you're a veteran and you're eligible. So that's something you could look into. And at $75,000 a year, you can get a nice house. You're probably, I would say, in the $300,000 to $400,000 range.
Riverside joined.
So I think, yeah, Juan, you need to reach out to us. You need to call us.
Yep.
Alma said 596. Juan said FICO. Now,
Okay, cool.
It's not FICO, okay? Yes, it is FICO that we use, but I'm not looking for your FICO score. We're looking for the type of FICO because there's FICO 5, 6, 8, 13, something like that. So there's these different models that people follow. If you're looking on Credit Karma, that's FICO 8. Different credit score for credit cards. We use FICO 5 for mortgages. So Juan, a lot of work to do. Let's figure it out. Alma Ortega 199. I took over payments on a VA loan, but I want to finance the property under my name.
Okay, so that's a little scary there, Alma, because if the veteran is still the note holder, then you don't already own that property free and clear because there's a note that the bank has on it. So that's a little something that you might want to look at. If you just took over the payments, did you assume the loan or do you just start paying it in his name? Paying it in his name, they actually have a name for that called straw buyer, and that's not a good thing. That's not a good thing, because there's something called a due on sale clause. Due on sale clause in most loans, they say, hey, listen, we're going to lend Lee the money. Lend Lee the money, and the house is the collateral. Okay. But if Lee transfers that name to somebody else, we want all our money right now. That's called a due on sale clause. So if I transferred it to Chris, and I said, hey, Chris, this is now your property, the bank's going to go, whoa, 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 whoa. No, nobody. We didn't lend Chris the money. We lent Lee the money. So give me all my money right now. And if you don't, I'm going to foreclose on that house because I have a lien against it. Can that happen? Yes. Does it happen? It hasn't happened a lot in the past, but it's going to happen a lot now because interest rates were so low that the banks were not incentivized to just go in and take the house over. But now that they're high, they're going to take the house back. They are going to take it back. So it's a problem. The way you do that is just a refinance. I actually have a situation where, like, hey, I want to refinance, but my ex-husband is the one who bought the house, and then he gave it to me, and then I got a new husband, but I don't want the ex-husband to know about the new husband, so we want to take it over. I'm like, wait, what? Yeah, we can do it, but all parties have to be informed, and they have to be on board, and it's not easy. It's actually pretty damn hard.
Juan, my FICO app. Okay, Juan, let me share something with you, okay?
Share it.
I don't know what my FICO app is. I don't know what that does. I don't know what system they use. So here's what many people do, is they say, here's what I believe the data is, and they want to make me give them an answer based on some data I have no idea about. Now take this to the medical field, okay? You go to the doctor, they diagnose you with something. And then you go to another doctor and say, hey, here's what the other doctor said. What do you say? Well, that new doctor is going to say, I'm not going to go off of their data. I got to run some tests. I got to do my own due diligence so I can come up with my result. So Juan, if you want real answers and you want to know where you stand and you want to know if you're able to buy today, I'm going to tell you one thing. Screenshot this and call one of us when we're off the air, and we can give you actual answers because we'll pull your credit, we'll calculate your income, we'll let you know exactly where you stand. And if you don't qualify, if you do not qualify, we'll send you on the right path to qualifying, whether it's fixing your credit, getting more income, whatever it is. We'll let you know what it's going to take in order to get you to that phase of buying a house. I don't want to guess. I never want to guess. And that goes for all of you. We don't guess when we actually pull your credit and put your file together. We're giving you factual answers for your situation. Francie M595, how long do we wait to pull a second mortgage equity loan if the home is rented out? Investment property, huh?
So if you want to do a second, there's LTVs, that's loan to value issues. Most of them are like 80%. There's some that can go, if it's cash out, you can go up to 90% on a VA loan. But most of them are 80%, 80, right? I think there's one that's 85.
Yeah, just know that investment properties are more difficult. There's less investors for them because the risk is so high.
And the rate is high. It's not small. I mean, I gave somebody a 9% quote the other day, like 9?
Oh, mad.
They were mad at me. I'm like, I don't get to choose. 9? I'm like, yeah,
file.
That's pretty good. Yeah, it's pretty good. 9 to 15 is what we're getting right now, 9 to 15. So the interest rates are very high. Don't think you're getting a favorable interest rate. But can you do it if your value is there and the equity is there and your reserves are there? What are reserves? Reserves are money in the bank that if I can't make the payment, I'll be able to make it from my reserves. But wait a minute, Lee, if I had money in the bank, why would I be trying to take money out of the house?
It's risk.
Yeah.
It's all risk, guys.
Yep.
So, like the answers or not, we're giving you guys truth. Help me get to that $20,000 mark. I mean, 20,000 like mark. We're at 5. So we need 15,000 more likes. If you guys help us out, it's going to help more questions get in here, and it's going to help everyone's scenario. Let's see, what else do we have here? Amanda Sierra. I have a car repo charge off for $4K from 2 years ago. Will that affect me from getting a house?
So, yes, a little bit, Amanda. When they look at your history, they look at how do you deal with debt? How do you deal with debt? And repos are a little different because I didn't pay my loan for 4 months and then they hired a repo guy and he got it. That's a repossession. Or I knew I couldn't pay it, and I voluntarily took it back. There's actually a designation called voluntary repossession. Because voluntary repossession is a responsible way to say, I bit off way more than I can chew. I can't do this. That's a responsible way. But if they had to send a repo guy and they took your house in the middle of the night, that's an irresponsible way to deal with debt. So there's literally a factor on the credit report that says that. Voluntary repossession, involuntary repossession. So those are a part of it. So that's a factor. Now, if you had other credit cards that you just defaulted on and they called discharge, means I didn't pay it off. I just let Wells Fargo eat it. I let MasterCard, who cares? It was $7,000. They're never getting it back. That's called discharged, okay? So they wrote it off and they took a loss. Now that goes into your bigger profile. And it says, hey, this person has not dealt with debt responsibly. So that's an issue. Now, the most important time frame is the last 12 months. If you have no lates in the last 12 months, you can say, well, I turned a new leaf and I found that having great credit is a very important part of my life, so I now pay my credit responsibly. Cool. Now, let's see how long you've been doing this for. If it's 12 months, that's good. 24 months, that's good. At about 24 months, it's going to start really reflecting in your credit. When you start getting into 36 or 48 months, nobody cares what you did 4 years ago. If you voluntary or involuntarily repossessed, we were all dumb kids at one point, and we did stupid shit. So it's the most recent 12 months, but if you've got a 606 FICO, the next thing I'm going to go is, okay, why? And I'm going to look at all the line items. So the underwriter is too, by the way. So I'm going to look at all the line items, and I'm going to look at discharge. Oh, shit. Voluntary repossession, involuntary repossession. Oh, shit. And then even if you do make the 580 FICO for FHA, there's no way an underwriter is going to look at this and go, yes. So that's the reality of it. Now, if all this stuff is over a year old, then I'm going to ask for LOEs. Tell me what happened. Oh, I lost my job and I got ill.
Yes.
Now, I can put that in front of an underwriter and say, hey, listen, it meets the guidelines of 580. And they lost their job and they got ill. Can you prove it? They will ask you, by the way. Can you show me some hospital, something that says they went to the doctor, they went to the hospital? Yeah, cool. Boom. The underwriter go, you know what? That's an extenuating circumstance. You got ill with the big C and you, cancer is the big C. No, the other one.
I put that
yeah, but you got ill with the big C. All right, cool. And then you beat it. Congratulations, good. And you know what? We're human. We know that shit happens. You got back on your feet. You're doing great now. The last 12 months look great. I can get a loan like that approved.
Like, hey, underwriter, I got Crohn's. The underwriter's like, so you poop a lot. How does that help?
Dude, don't.
So Amanda, I'm going to elaborate a little bit on this. So how your patterns, so that your credit shows your patterns, okay? Because it shows us the day that you were late. It shows us the day that you're repoed. It shows us the day you filed bankruptcy. It shows us all the data, okay? So if an underwriter looks at your credit and says, this person has fantastic credit, but this repo, just one thing here, and then after that, everything's fantastic. Mm-hmm. Something happened here. Something happened. Let's figure out what happened. And like he said, maybe you went through a breakup. Maybe you co-signed for someone. Maybe someone else you thought was making the payments and they weren't. So something could have happened. And at a 605 FICO, or 606, you are in range to buy a house. You are in range. So if we pulled your credit and all the history was good except for that repo, you're likely to get a house, especially like what he said. As long as nothing's happened in the last 12 months, you could be a homeowner. And like I said earlier, as long as your credit history and the patterns are showing that you're good, yeah, I think you're a good candidate to buy a house right now.
A couple things to say. One, happy birthday, Austin. Number two, we've been Chris and Lee. We appreciate you.